Okay, so today I have with me a very special friend, actually. I'm not going to call him a guest, to be honest. A friend that I've known for a very, very long time. And they've invested approximately $78 million. That's how much their portfolio is. And they've invested in some of the most known startup brands that we might know. Today, I'll let him tell you which brands. Manish, thank you so much for coming. Join me on stage, my man. I'll give you this. Yes,
This is work,
is working?
I guess. Yeah.
Yes, great. Manish, thank you for being with us today here.
Thanks for having me, man.
No, definitely.
Really impressed with what.
Yeah,
you've done
I've been
together. Really
asking
good
you for
stuff.
2 years to come on stage. Yeah, thank you for coming. Okay.
Thank you for getting me.
You know what? Tell them who Manish is and tell them
course.
what you do.
So, started my career in finance, traditional finance. I was at a family office. We're investing across asset classes. So, I was in real finance. We were doing equities, we were doing real estate, we were doing private equity. But one of our pockets was doing venture capital. So, that was mostly if we were either investing in funds or we were doing direct growth stage investments in global companies. So, that's where I got my first taste of venture capital. From there on, I got an opportunity to join a very special VC, a very well-known VC in the region called Wonder Capital. Learned a lot of things there. Really, it was a big change for me because, when you're in traditional finance, you're looking at both the numbers, the quantitative aspects of it. And when you join early stage VC, that's when storytelling becomes more prominent. That's when you're investing in founders. That's when you're investing in qualities. And you don't know, the business you invest in today is not the same business 5 years ago, regardless whether it becomes successful or not. That happens a lot. So got my first taste of venture capital, spent a few years over there, joined EQ2 Ventures in September of 21, and I've been there ever since. So just to give some background on EQ2, we are early stage investors in Middle East and Africa. We actually started as a corporate VC for a media and advertising company in the region, very prominent name. So the idea was we were investing in companies that would eventually be disruptive to them. This was long ago. This was in 2015 when I didn't join them in 2015, but that's when EQ2 started. We were investing in digital content. We were investing in influencers. We were investing across that spectrum. Took that, being one of the first few VCs in the region, we are seeing the first on-ramp of tech businesses that were coming in, and usually consumer, because internet penetration was becoming a thing. People were having more and more mobile phones, so consumer businesses are first ones that usually come up.
You guys invested in influencers?
We did invest not in people, not directly in people, but we had Arabi ads, yes. We invest in Arabi ads. We invest in Alfan. So yeah, influencer monetization companies. And that's where some of the brands that Ronnie mentioned. So we were in a position where we could give money to these companies, but also help them because we knew what it takes to acquire customers, retain customers, monetize them. So we invest in companies like CarSwitch, Golden Cent, Fresher, Iwa. So those are some of the names that you will have heard. So we really made a name in consumer brands. I think we built a very nice portfolio. Right. No, we're not investing in Tabby.
Oh, come on, really?
Hossam is on our investment committee, but we're not. Okay. That was a miss, for sure.
Okay.
So,
how do you feel? No? You don't feel good about it?
I can't sleep at night.
Okay. Yeah, let's not use Tabby, yeah?
So many. But yeah, I'll kind of stop it there because early stage investors, Middle East and Africa, I think that's...
Great. You guys have been, investing, all over the place in early stage startups in the MENA region, across the MENA region, right?
Even Africa. So we've been doing a lot of...
So my question to you today is, we have plenty of, I think most of the audience here are early stage startups. And, the process is you build a pitch deck, couple of slides, up to 10 slides, 11 slides, depending on the stage you're at. Pre-seed 10 max, they say.
Yep.
Now, as a pre-seed, all right, can you let us know what is the most important slide on every single stage? So, pre-seed, what would be the most important slide for you versus seed round, for instance?
So, of course, we're assuming that I haven't met the founder yet. So if a pitch deck comes across my desk, I'm looking for really two things. Because first and foremost, at that stage, you're investing in people. Not in. I mean, the problem statements will change, especially with AI, things are moving so fast. The problem that you're solving for might not be a relevant problem 2 years from now. So first and foremost, people, like, who are you? What have you done? Who's your co-founder? Who do you have with you to help you alongside the journey? It's a tough journey. Like, I've never been a founder, but I've kind of lived precariously through founders we've invested in. It's a tough journey. So who's the team? Who are you? Who's your co-founder? Second, most important thing is what problem are you solving? So it kind of denotes the depth of the problem, because you could be solving a really cool or pretty deep problem, but the market size of that problem could be tiny, minuscule. So as a VC, you want to invest in probabilities, and one of the probabilities is you're building for a market that's massive, ideally.
That's pre-seed and seed.
That's pre-seed, and then seed that starts becoming, then your numbers start becoming more relevant. What have we done? Who are our first few clients? What does a product market fit look like? So it changes a bit at seed.
Okay, and I think, we have some debate, let's call it that way, right? Like, what would be a pre-seed for you? Like, what kind of MRR are you talking about?
It's a good question. For me, anyone who's not achieved
Victoria,
revenue
that's for you.
is...
I don't know if, yeah. No, that's not only you, by the way. It's just everyone. But yeah.
Look, for me, if it's... Again, there's so many distinctions, and yes, this is always like, we are not seed, we are not pre-seed, we are not this.
We're always in this debate.
It's always. But for me, and it depends. But for me, if someone hasn't achieved revenue, it's a pre-seed company.
Okay.
Now, again, you have some companies that are building extremely deep technology, and it takes them years and years to monetize. You can't really call that a pre-seed company, but those are exceptional cases. But the norm for me is you don't have revenue, you don't have product.
It's pre-seed. Yeah. And if you have any kind of revenue, you consider it directly a seed.
It depends. Again, I would say 100, 200K in annualized revenue. At that point, you...
100, 200K?
Yeah, at the minimum. Again,
dollars, you're talking about dollars,
yeah. At the point, you start qualifying for seed, but again, it's a spectrum, man. You see companies with 5, 6, 700K ARR who are also seed stage.
Okay. I'm glad. Now we can settle this debate, by the way. So pre-seed, no revenue. Seed 100 to 200.
It doesn't really matter.
No, it does. We would debate a lot of this. So my next question before I give the audience. So what have you seen? All right. I mean, you've seen a lot of pitches. Okay. First of all, how many pitches do you receive on monthly basis?
I can't put a number on it, but it's... Especially now with AI, people are automating their outreach.
You always ask founders to put a number. You can't put a number.
No, we actually have stats. But the thing is, we stopped recording in our data with CRMs, cold pitches, because there's so many. It's complete.
Would you say no for cold pitches?
If it's clearly AI generated, yes. Like if there's no personality to it, and you can tell, right? And a lot of times you don't have your systems in check. So my name is not right. The VC is wrong. Like, hey, you had Backo Capital. And like, no, that matters. So we don't, because we used to respond to every email before in the past. Yeah. Now we don't. Like, if it's clearly AI generated.
So why don't you say no if you don't want to invest? You have a lot.
This is just cold outreach. I don't know who this person is. And it's clearly outreach. It's AI outreach. There's no effort that's been made in the inbound. So I would not, until I have my AI system set up also, so my AI can say no. Okay. But before that,
good one.
So I'm not gonna, for the most part, like if there's some level of work the founder's done, we would reply to it. But to your original question, how many pitches, man, it has to be hundreds. I would say 10 to 15 a day just to my email, but then we have an info email, and then we have other team members, and then we have LinkedIn, so it's... I think 10 to 20 would be a fair assumption, but probably more.
I really think our AI should go out for dinner. Really. let them talk. Let's see what they might come up with.
Reach out to my AI. We'll talk.
Great. I have so many questions for you later on.
Absolutely.
Questions? No, because I want to give you the floor. I want to give you the floor to ask your burning questions. Khalid.
Generous, man.
Yeah, I know. You're giving me the 10 million, right? Or no?
One of the big questions that I've spoken to VCs on the podcast about is the whole founder discussion of team versus no team. So from your experience, how important is it to have a team to be investable rather than just being a solo founder? Because that's a big debate.
Actually, that's a really good question, because we have this debate internally. We're sitting with a great founder just the other day, fantastic founder, second-time founder, solo founder. And even now, and Ronnie and I were talking about this, single founder companies, single person companies. It's becoming a thing. I think we're a bit more old fashioned, so it's going to take us some more time to become comfortable with the concept, because we have to think of it from, again, probabilities and risk. One founder might leave, something unfortunate might happen, and it's a tough journey. You need someone to talk to, and your agent is not good enough yet, right? So you need someone to talk to, you need someone to bounce ideas off, someone who can balance you out. You need a yin and yang. You need someone with complementarity in skill set. So for us, yeah, good.
Is there anything from a contingency perspective you guys can put in to manage that risk of going with solo founder?
When you say contingency, it,
Like in the contract, like so they can't leave or whatever.
we, we could. There are VCs who negotiate like key man clauses. That does happen. There are insurances that people take out on founders. So that does happen. But again, it becomes more philosophical than how to put the right terminology around it. And for us, philosophically, we've seen the success rates. We have backed. I mean, it's and this is again, it's based on our personal experiences. It's just better off to have for us. Yes. Again, there are different ways to go. Yeah.
Question. So out of all the company you have invested, how many have failed? And also, what's the most common reason?
In our portfolio today, actually we have a fairly decent failure rate. So we have two to four. Again, because some of them are
Two to
no a number. So out of our portfolio
of-
companies of 28, we have
Okay.
2 to 4 that have failed. But again, the reason I'm not giving you an exact number is because some of them are kind of alive, not fully shut down. But again, we've technically written them off. Most reasons for failure. So one of them is just product market fit. You invest in a thesis. We invest alongside you as a founder in a thesis, and the thesis simply does not work out. Again, it's like we shake hands and we part ways. It's the business that we are in. But yeah, sometimes at an early stage, you think that something is going to work out, that the market's not there, your acquisition spend is too high, there's some regulatory headwinds against you. There's an infinite number of things that could happen, but you just didn't find your product market fit. The second one that becomes prominent is founder or team. And you underwrite team. At the end of the day, you're underwriting teams, right? And sometimes you think you're aligned, and because it's almost like dating. So you meet each other, you get to know each other, and you get comfortable with personalities. Sometimes it does not work out because you invest in a person, and that person was somehow different to what you thought you were investing in. They start burning too much money. Their focus is not in the right place. They don't know how to hire well. They don't know how to build teams well. So a lot of it, I think, most of it comes either like early stage failure of product market fit, or maybe it was just the team was not right. Yeah, absolutely.
Hi, thank you for
Hello.
coming. So I want to ask, as investors, you do ask how long is your runway?
Your
Or
runway?
how many months until you finish your money? I want to know, what do you want to get out of the answer? Because for me, for example, similar dynamics happen when I hire someone. And I know they are like 2 weeks before their visa expire, and I give them a less than a lower range offer, and they take it. But a few months down the road, it affects the relationship because they had to take a lower offer. So is there a similar dynamics happen between founders and investors?
So, interesting question, because we don't ask for runway until we are a few, because initially you're, again, like I said, you're looking at founders, you're looking at markets, you're looking at, is this a viable business? Am I excited about this business? So we don't get to a runway conversation until probably 2 or 3 calls in, because we're not looking at the balance sheets, we're not looking at cash in bank. It's too early, right? Like we need to make sure that we actually like this company, we like these people, and do we want to take it further? Yeah. Yes, so now the runway conversation. Again, I can't speak for myself because I don't lead with this conversation. But the reason why a VC would ask you for runway is kind of a sense check on how much in trouble are you? Because sometimes you could really be in trouble, right? You have 50K in your bank account. And first of all, and that leads to a few different things. Of course, negotiating becomes part of it because you're distressed and you will take money at a low offer probably. Again, a lot of VCs don't think about this, but it's circumstantial. The deeper question it leads to is how did you get here in the first place? Why did you let your company get to a point where you just, you have a month of runway left? And that would be for me the more important question in this case. And runway for me, like I find myself asking about runway more to portfolio companies than to potential companies who are pitching to us. I think for me, it's, you don't want to, we're not looking for deals, right? We're looking for great companies. Runway will become a question. The question will be, why did you get here? I, as a VC, I'm sure people negotiate, but I would not go like, okay, now this is a chance for us to get a better deal here.
I want to ask you a question. Recently, the technology, you invest in people and in technology. Recently, the technology is so fast.
Yep.
Like today, business, the second day, it's obsolete, it's gone. Or someone else is doing it through a prompt. How is this affecting your decision in investing?
It's tough. It's tough. I think the challenge, everyone here in the room is facing this challenge. We are facing this challenge. You invest in a company and that company might become irrelevant in 6 months. So how you can downside protect yourself is invest in founders who build companies in where they have sector expertise. So they have domain expertise and they have skills that AI probably cannot do, at least for the foreseeable future. Yes, like building commercial teams, going out and selling. Like these are things, I mean, of course, it can change. We've said a lot of things, of course, won't happen and they happened. But again, you're investing. So being adaptable, being able to shift your product, being able to shift your go-to-market, being able to sell, go out in the market and actually sell your product, those are things that probably in the short to medium and hopefully long-term, AI can't do it. But I won't lie to you, like it's a question that really troubles us also. If investing in pure technology companies, that technology might not be, that product might not be defensible. 6 months down the line, that might not be defensible. We look at our portfolio and we look at this, okay, this might, the last Claude launch, the last, what Gemini did, what XYZ did, this might really disrupt their pretension. So yeah, I don't have a clear answer for you. Unfortunately, I think we're all figuring it out as we go.
Hey Manish, in your personal experience, what are the best uses of funds you have seen for a seed series fund-raised startups in this
Series
region?
C, you mean?
Seed series.
Oh, seed.
Seed round.
So there's usually a pie chart that most founders come out with. And you have, again, like you have your marketing, you have your product, you have hiring, you have your sales. So you have the classic pie chart. Again, like I think it used to be 6-7 years ago, a lot more money would go into product development. It's changed a little bit because launching at least MVPs or early tests and products has become cheaper. So now for me, it's hire the right people. One of the red flags for me is always when a large chunk of your fundraise goes towards marketing, because that means you don't have an effective go-to-market motion in your company. You don't know how to effectively go out and acquire customers. That means that's why you're spending so much on Facebook ads, on Instagram ads. And for me, that comes out to be a red flag. So invest on hiring, right? Don't bump up, as a founder, don't bump up your salary to like $500,000, something crazy, right? Like that would be a red flag also. Hire the right people, invest accordingly to product because you want your product to speak for you to a certain extent. And yeah, sales and marketing should be maybe based on your revenue, it should be 10, 12%. You can't get too aggressive with it.
Hi, over here.
Hello.
I have a question. In the region, what are the competencies that you're seeing or missing the most? And this is probably more at like seed than before, in terms of which functions. Is it customer success? Is it commercial leadership? Is it product? Is it product marketing, etc.?
So commercials, it's a good question because a lot of times commercial, and I think the region is quite strong in general, broadly speaking with commercials, but at the early stage, building commercial teams costs money, and that's why it's difficult because, people working commercial roles do have good salaries, have good bonuses. So building those teams as a startup does get difficult, and that's one of the bottlenecks that we see a lot within the sector, within the space, within our portfolio companies, like actual commercial teams. So I think you've brought up a very important point. So across, like account managers, customer success. When you're a massive team, you have the resources, right? It's also a question of resources. You have the resources to build the function pristinely. But when you're an early stage company, but you have your SME, with SME software especially, the demands are high, the payments are low. So building the right kind of teams there becomes really difficult. With enterprise, at least you can offset that a bit with the contract sizes. So definitely commercial teams. And technology has traditionally been, tech teams have traditionally been a bit of a bottleneck. I wouldn't say to a large extent, because now you have hubs, like you have great teams out of Lebanon, Egypt, Eastern Europe, you have South Asia. So you have great hubs. Ultimately, you do want to build those teams in-house. So scaling those teams can sometimes get challenging from a cost perspective, but it's not as large. And now with the advancement that you have with AI, where you can scale up your teams a lot more, so you're not so constrained by headcount. It's become less of a bottleneck. So I think commercial. I think it's always about your sales teams, your marketing teams, your retention teams. So that's usually a big constraint. Actually, finance teams too, sometimes, and that sounds a bit surprising, but a lot of teams at the earlier stages don't have the finance functions in check. So having a hold on your dashboards, having a hold on your data, having a hold on where you're burning money, where you're making money, who your clients are, what your retentions are, what your cohorts look like. I've seen a surprisingly high number of companies not focus on those metrics. So I don't know if that's a talent gap in the region or if it's a focus gap on early stage teams. I'm not sure what the right answer is, but I think the people would be there. I would be inclined to say the people would be there.
Manish, another question here.
Hey, Dachi here. Thanks for being so generous with your advice. I was wondering, how would you think about equity share and option pool? Have you seen any red flags?
So the rule of thumb is, again, it depends on founder relationships. So you can see 40-40, you can see an uneven split if one founder has more experience or just better caliber, whatever it might be, right? The founders can define that. Of course, one co-founder having 10% and the other one having 90% is clearly a red flag. But 60-40, 70-30, 65-35, I think in those ranges, it's more or less fine. Being able to defend why that split is as it is important, but it's fine. ESOP pools, we recommend 10%. So that's market standard, that's usually rule of thumb. Founder vesting is also something that we focus on. So having a vest over 4 or 5 years, because again, the company looks wildly different 4 or 5 years in. One co-founder could leave, a new co-founder could join. There are so many things that could happen, and having those vesting agreements set up from your first equity round, or even actually before you bring in a VC on, even from get-go, having those vesting periods, because then we've seen so many situations where a co-founder has left 4 years ago when the business was nothing, and now the business has really become something, and you have a co-founder who's still on the cap table with 20-30%. And you ideally don't want to be in those situations, so leave those safeguards with yourself, with vesting. It's fair for everyone, and it keeps everyone long-term incentivized.
Hi, Manish. Ronnie.
Nice to meet you.
What happens once you have a dead sorry, not a dead one.
Dark.
No, a founder on a cap table that you cannot, that actually left a dead founder for, yeah. So
Going all black, that's a sinister question.
So what usually happens? Is there like a specific strategy?
You have to buy them out.
You have to buy them out.
So
okay. That's the only way.
Yeah. So secondaries, there's no legal precedent. You can't kick someone out when they actually hold shares, when the shares have been issued in a company. You can't. So you have to buy them out. Now it's up to you to negotiate the right deal with them, because there's always discounts on secondaries. So you can be a bit creative with deal structuring, but yeah, you have to buy them.
When are you going to give me the 10 million?
If I had 10 million.
Manish, thank you very much. Thank you so much. A big round of applause for Manish. Thank you for being with us, my man. Thank you.